Welcome, everyone. This is a new episode of Deriv All Access. So let's cut through the noise together and make sense of what's happening in the market this week. I'm Yoli, your host, and Deriv's head of marketing. And today I'm joined again by Prakash Bhudia, Deriv's head of product and growth. Welcome, Prakash.
Thank you. Thank you, Yoli.
So, in a surprise move and after a long statement war, the US and China hit pause on their tariff war, with the US slashing duties from a crushing 145% down to 30%. And China has responded in kind with a cut to 10%. So it looks like the markets are relieved, and Trump has called it a total reset. So is this the beginning of a new chapter in global trade or just a temporary ceasefire? What's your take on it?
So I think that's a very interesting question. And I think while the markets were already pricing in optimism that both sides were meeting in Geneva, right? The announcement itself, i.e. the rollback of the bulk of the April tariffs in this 90-day truce, was very surprising, right? So you saw very sharp, broad moves across all the markets. And while positive, it's important to note, of course, that 90 days is a very short time to tackle these long-standing disputes and concerns that both the US and China have. So, for example, concerns about state subsidies, or IP theft and uneven competition, which is what President Trump has highlighted on a few occasions. I think these structural issues still need to be tackled. So I think the market definitely was caught off guard with this optimism. I think we can view it as a temporary de-escalation more than a permanent peace. And as mentioned, I think the strategic long-standing competition between these two nations has not gone away, right? So I think both the US and China will remain locked in this strategic battle. So I think part of what might one expect is I can see more twists and turns in this saga. And if you, for example, look at the move, you can see that there was a lot of cash on the sidelines which was put to work, and there might have even been kind of FOMO sentiment. If you look at the CNN's fear and greed sentiment index, currently it's showing greed. So essentially, that's saying greed is currently driving the U.S. equity market. So we have probably overshot on the upside, and we have seen some consolidation taking place over the last couple of days. And I think there definitely will be some more twists and turns because the underlying structural issues have not gone away. So is it a reset? I don't think so.
Yeah, so I guess to be continued in another 90 days. On the macro and geopolitical landscape, the Federal Reserve held interest rates steady. The Bank of England cut rates for the fourth time this year, down to 4%. And there's fears perhaps of a global trade war. How do these contrasting monetary moves reflect on each economy's current priorities? What are you seeing happen versus the UK versus the US?
That's interesting. So if we start with the Fed, as of the latest meeting, the Fed held its benchmark rate steady at around 4.25 to 4.5%. So they opted to pause after a series of cuts last year. And while US inflation is off the peak, it's still somewhat above target. And I think there was always concern that that the new tariffs could push prices up even further as growth shows some signs of cooling. So the Fed did in fact acknowledge that the risks of higher inflation and high unemployment have risen. So basically flagging stagflation as a risk, which I think is a big reason why they've adopted a wait and see strategy. So on the other hand, you have a strong labor market, which has given the Fed some room to be patient. And Fed communication has been pretty transparent. We have the futures market now only pricing in a gradual easing later in the year. I think it's about 2 cuts. And now if you compare this with the Bank of England, the Bank of England has shifted decisively into easing mode. And they've recently delivered their 4th cut, bringing the policy rate down to 4.25%. So, why so dovish, one might ask. And if you look at the UK situation, inflation has fallen much more sharply from its peak, and with price pressures, easing, the Bank of England has more room to worry about growth. So indeed, the UK economy is looking lackluster compared to the US economy. Employment data has been softening, and the BOE, interestingly, removed previous guidance that future cuts would be only gradual. So dropping that language was essentially a signal to the market that the Bank of England was willing to cut faster if needed. And of course, the UK interest rate, the interest rate swap markets have priced in up to 4 cuts this year. So what is interesting, of course, is we have this divergence. We have the widening interest rate differential between the two countries, and this has weakened the pound against the dollar. So this kind of market reaction is what is expected, right? However, in recent days, we see the initial reaction has been for the pound to weaken against the dollar. But what's interesting is that cable, which is the GBP USD FX rate, is proving to be much more resilient in the near term. And this could be for technical reasons. For example, given positioning data has been showing a short squeeze, and that's been driving cable higher. It could also be macro factors such as the global reserve diversification. So of course you had the US-UK trade relations improving, but on the other hand, you have headlines which suggest that President Trump prefers a weaker dollar. So that's creating headwinds for the dollar. So despite the point I'm trying to make is despite the policy divergence between the Fed and the BOE, it doesn't seem to be a straight path lower for cable. So you might expect that cable would move from its high of 1.34 back, let's say under 130. But in fact, while the markets initially, you saw the price moving down to 131.5, it's actually been very, very choppy. And if you look at, for example, major financial institutions and their forecasts, they're very, very divergent, so there's a huge range in where expectations for cable are. We have on the one side, we have Goldman Sachs, who are bearish the pound. looking at a year-end forecast of 1.2. On the other hand, you have Bank of America, who's looking at a forecast of 1.43. And then we have some banks which are neutral, looking for a forecast around the 1.3 area. So it's very divergent in terms of forecasts. And I think it's not going to be a straight path lower for GBP USD, despite the policy divergence between the BOE and the Fed. And what is likely to be the main factor here is the narrative of possible continued dollar weakness. For example, in the move straight after the tariff announcement, we had dollar yen spiking up close to 148 level. And in the last couple of days, it's grinded back towards 145. So you can see the expectations for the market seem to still kind of be this weaker dollar narrative. And that's also why cable has not just had a easy path lower.
So it seems like, there's a lot for traders to keep in mind and consider. You mentioned a few times that it's not a straight path. For Forex traders, is this a good environment? Like, is this level of uncertainty or volatility a good environment for trading?
Yes, of course. I mean, there's big moves on a daily basis. So I think it's a very good environment. Traditionally, currencies have, of course, been a lot less volatile. So if you look at a lot of the major peers, the ranges have been fairly narrow. However, with now all of these different narratives, it definitely allows for traders to look at levels and decide how they want to trade this. For example, right, if you're holding dollars versus the yen, you can look for long positions, right, where you can earn a high daily carry by being long dollars.
That's exciting for traders. You also mentioned stagflation, which my understanding is kind of a rare dilemma where the Federal Reserve has to mitigate the risks of both higher prices and more unemployment at the same time. So what does that mean for markets? Like, how should traders be looking at this? Who would be the biggest winners if both unemployment and prices kept on the rise?
That's a very interesting question. So if you, for example, look at the markets, right? So even though the Fed now have codified their concern, right? You saw the May statement from the Fed noting that the risks of higher unemployment and higher inflation have risen, right? So they essentially now have brought this stagflation narrative into the public domain. So essentially, they're acknowledging that, hey, this is a situation where both our goals, right, so stable prices and full employment, could deteriorate together. And of course, it's a nightmare scenario for a central bank, right? Because the usual policy tools for inflation, right, can worsen unemployment, and the tools for unemployment can worsen inflation. So it's essentially the Phillips curve relationship. So it's interestingly the bond market, which is where you might see some of these worries being priced in, is a little bit conflicted, right? So one day, hey, the bond market seems to be worried about recession, and you see this with a flattening in the yield curve, and then the next day they're worried about inflation and possible stagflation, and over here you see essentially what you'd see in the pricing of the market would be the selling of the long bonds, steepening the yield curve. So keeping an eye on these signals, i.e. a sharp steepening of the yield curve, especially driven by the rising long-term yields, could indicate how much the market is pricing in a possible stagflation scenario. But right now, we are not seeing any of that being priced in, i.e. it's not a base case at all, even though the Fed is openly talking about it. So in this situation, of course, if the yield curve is steepening, you want to avoid long-term bonds, right? And also long duration growth stocks. And what we did have, of course, the episode of stagflation back in the 70s, and generally we saw commodities and real assets shining in stagflation environment, while equities and bonds were struggling. So I think that's kind of the core winners, the high-level winners and losers. But as mentioned, it's not a base case yet. But of course, we are now seeing more and more chatter about this possibility.
So for those who are new to trading, when we talk about winners and losers, in the case of stagflation, when you talk about the kinds of stocks that tend to do well in a stagflation scenario, for those who are new, are you talking about stocks like, are there some brands you could mention? Like, is it like more along the lines of like a Coca-Cola versus like a growth stock, like a CrowdStrike? So what should new traders be thinking about?
So I think the same kind of industries which will benefit if tariffs escalate, right? The whole tariff story escalate, could also possibly do well in a stagflationary environment. So we're talking about consumer discretionary. We're talking about supply chain industries. I think these types of industries are likely to do much better than growth stocks.
Makes sense. Okay, let's talk gold. So the gold gains have come to let's just call it a pause. It dropped to a 2-week low, pressured by rising yields and a stronger dollar. Is the recent retreat, in safe haven assets, temporary, or waiting for the final outcome of the sort of U.S.-China relations? Or do you think it's much broader shift in investor sentiment?
Yeah, that's a very good question, right? So you've seen the narrative on gold changing drastically over the last couple of weeks, right? A few weeks ago, we had the gold price flirting with the $3,500 technical level, right? So, of course, in the last week or two, we've had this a stream of optimism. So risk appetite has improved, and we've seen this classic rotation out of safe havens like gold. So we've seen, for example, the knee-jerk reaction was the dollar strengthening. We've had real yields on bonds rising as well, and both of which have been traditionally bad news for gold. Of course, gold is priced in dollars globally, right? So the combination of a stronger dollar and higher real yields means that investors may prefer to hold dollars or risk assets rather than holding gold. And with gold falling closer to the 3,100 level, that's really triggered some momentum selling now off the highs by a notable margin. Of course, we have the camp which say, this move is temporary, and the drivers which propelled gold higher largely still remain in place. And these drivers essentially are central bank buying, right? So this is kind of the theme of de-dollarization. We have a record amount of central bank buying, particularly emerging markets.
Yeah.
Gold is still traditionally a great a hedge for long-term inflation. The geopolitical, the tariff story is not completely over yet. So all of these are still in play. Seasonally, of course, gold performs well towards the end of the year and into Q1. Saying this, I do believe that we need a catalyst to renew a stronger upward momentum, right? So otherwise, it's very likely that technicals play a big part in the short term. And right now, technicals suggest the price could keep moving lower. Of course, the big support level would be $3,000, right? That's the nice round psychological support level. And of course, in the structural camp, right, we have risk assets which are now doing well, and of course that's why gold has lost some of its allure. There's that possibility also that some of the big players who bought gold for insurance will also use this opportunity to trim some of their holdings. Of course, we've had outflows in ETFs. If the Fed holds or cuts rates into the end of the year, that could also be a scenario which is tougher for gold as well. So it's not clear at all. Right now, short-term technicals are playing a big part, which is why the price has come off its high and has been drifting lower. But it definitely needs some catalyst to renew its upward momentum.
With market optimism returning, is crypto benefiting from a risk-on appetite, or is it now trading more like a macro asset?
That's a interesting question. Yes, of course, we have seen, particularly in the last couple of years, Bitcoin has been trading with a high correlation to tech stocks. So, for example, in the recent risk-on wave, we saw tech stocks soar, and also Bitcoin also rode the wave. Yeah. And I think the positive correlation to the NASDAQ 100 is around 0.75. So it's a very high correlation. And analysts have suggested a big driver behind the sustained uptrend has been adoption from institutions. So I think in the short term, we're very likely to see the positive correlation holding. So it's likely to remain a risk asset. In terms of metrics, like, for example, on-chain metrics, there are some signs that, the recent bullish move is sustainable. So, for example, the number of active addresses has been rising. I believe just in the last couple of days, it rose to a high of 850,000. And we have transaction volumes which have also been spiking. So we've seen a few bullish signs from these on-chain metrics. But on the other hand, right, we have, of course, seen short-term selling, right? It's after getting to these high levels again, there's going to be a certain amount of profit taking. But so far, there does not seem to be any kind of signs of any major dump. In fact, long-term holders of Bitcoin, i.e. those who have held or not touched their BTC in more than 1 year, are, as a cohort, are at all-time highs. So it's essentially a sign that investors are holding onto their Bitcoin. So in terms of technicals now, if we see Bitcoin decisively breaking above 105,000, right, on strong volume, I think it could trigger another leg higher as momentum players jump in. On the other hand, right, we could see consolidation or even a healthy pullback to the 95,000 range. In any case, I think the underlying correlation with Nasdaq is quite strong now. So I think Bitcoin will take its lead from risk assets.
So hopefully, this actually is probably a good spot to plug that you can trade cryptos on Tariff, because you typically see after a move with Bitcoin, you see a move with altcoins. So there's probably some plays there. Let's switch over to S&P 500. It surged more than 3%, trimming sort of year-to-date losses to just 0.6%. Is this rally sustainable? You think it's driven by the U.S.-China temporary agreement? Is it relief-driven euphoria that could face headwinds from inflation data or some other geopolitical surprise? What do you think?
Yeah, so I think I do agree with the sentiment that maybe the rally's been overdone. So of course, yeah, if you have managed to buy in the dip, right, and traded the volatility quite well, right, you're in a situation where you're sitting on some profits, I think it is a good time to take some profits and take a step back. And of course, if you look at the rally, 100%, right? I think it's on the back of these upbeat developments, which I think still have some twists and turns to play out, because as mentioned before, the structural issues still remain. Now, if you break down into the different areas, for example, if you look at the earnings trends, ultimately we expect stock prices to follow earnings in the long run, right? So recent earnings have supported stock prices, right? Because they've been holding up better than expected. Many companies have beaten their lowered expectations, and the guidance was really not all that terrible. However, in terms of growth, earnings growth, it's modest at best. And so we're not really in a booming profits environment. So if we look at the S&P 500 forward price earnings ratio, it's back at around 18 to 19, and that's somewhat above historical averages. So I think with metrics, with these indicators where they are, we have that the stock market currently does have a lot of optimism already baked into it. And I think so from here, for the rally to sustain, we will need either an acceleration in earnings or at least some stability with no negative surprises. So the good news is that certain sectors like tech and consumer discretionary have shown resilience. And if the economy avoids a recession, we could see a re-acceleration in corporate earnings. But of course, now the risk is if margins get squeezed by any lingering cost pressures or if demand softens. So, we have to pay attention to Q2 earnings forecasts and whether they're met. And I think if a less hawkish Fed, if we do see a less hawkish Fed, that's likely to support stock valuations as well. If you think about the Fed stance, while it's not policy is not accommodative, right? I.e. the Fed has not been cutting rates, but instead actually the Fed's been doing QT. So we do have this shrinkage in its balance sheet and a tightening of liquidity conditions, right? Purely because the Fed is shrinking its balance sheet. So this could cause some headwinds to stocks, even though the Fed is not tightening, i.e., hiking rates. So I think we have to watch this as well. Rate cuts, I think, later in the year, if those get priced out, again, that may cause some headwinds to stock valuations. If inflation flares up, and the Fed stance becomes hawkish again, that could cause some headwinds as well. So, as mentioned earlier, the sentiment's currently showing greed. I mean, while this can fuel the rally in the short term, we need fundamentals to back this up as well. So there are a lot of tail risks, I think. Weaker earnings outlook, a failure to negotiate after this 90-day truce.
Thank you so much, Prakash. I think you've really helped us sort of cut through the noise of the week that was. Anything else that traders should be thinking about for the week to come? Are there any economic events or anything that, as a trader, you would be keeping your eye on? It sounded like the advice was, if you've been in a profit, and if you've had some profit, maybe take a look and think about taking some profit. Anything else that you would, point to that traders should be looking at for the week ahead?
Yes, I think in general, I think we're still in a kind of regime, a political regime-based volatility. So again, we've seen time and time again over the last couple of months that headlines, and social media sentiment can move markets quite considerably. So the expectation is that this saga is not over. We're just waiting for the next headline. And like I said, we do need to keep an eye on what other news is coming out with regards to the tariff posturing. And I think this story is not over. Like I said, I think the strategic battle between the US and China, I think this is going to be fought on a number of fronts. So having your ears to the ground and just seeing how these stories are developing would be key. And in terms of data, I think the key data to watch is more direction from the Fed, because while they wanted to wait and see on how the tariff saga played out and its impact on inflation, the surprise here could be that they end up being very dovish. So essentially, they're waiting to make sure that there's no risk for higher inflation or inflation expectations being revised upwards. But if that risk is now passed, it's almost like you're now removing this hurdle. So, okay, fine, now we can go and be a little bit more dovish and cut rates. So that story would be interesting as well if they turned around and gave a surprise dovish signal. So I think the inflation data, if inflation is coming in lower than expected, we could see the Fed becoming a bit more dovish. So I think these are the main stories to keep an eye on. And over here, of course, we have a lot of inflows, there's huge inflows, daily inflows in and out of all the different assets. So looking for assets which are which are overstretched in their moves. I think this is a good source of ideas.
Thank you so much, Prakash. And we look forward to hearing from you again next week. I'm sure there'll be more excitement and volatility in the markets.
Thank you. Thank you, Yoli.
And for those of you who are new to Tariff All Access, please hit the subscribe button if you are watching us on YouTube and turn your notifications on. If you're listening to us on your favorite podcast, hit that subscribe button. And we'll see you next week.